Yeah. Hi, Neal. Looking forward to a great session today.
It's always great when you and I do it together.
We have a lot of terrific guests. So fortunately, I can't see everybody, but
and they don't want to see each other. And
many people who I have met personally, and
you don't ever say Joe Smith asked the following question. You just pose the question, right?
Correct. Okay, we're just going to wait for the session to fill up now that we've started the webinar live, and let's just give it another.
Well, they'll tell us. Is Rachel going to tell us when to start?
No, we're recording now. We're live. So we're just, what do they call this? Pre-webinar warm-up. Okay, we just have a few people in. Let's just give it another minute or two. And when we have a few more attendees, we will we'll get started. We're expecting a big group today.
Hopefully.
Well, it's an important topic. And it's information that I think people want to have. So I know that there were a couple of people who signed up who said that they could not attend at this time, but they were looking forward to getting a recording.
Nobody's hearing us, are they?
We'll have that.
I think we begin.
Okay, let's get started, Neal. I just want to welcome everybody to our first plan giving webinar for 2023. It's an important topic, not just for friends of Yad Sarah, but for those of you who are out there who would like to learn more about how you can increase your lifetime income and provide for your favorite charities at the same time. Neal is our expert in the area of charitable tax planning, and we have an important program for you today. I wanted to let you know that if you have questions during the session, to feel free to post the questions in the chat, and I will direct the questions to Neal, and he will be able to answer the questions live. I'm going to turn it over to Neal Myerberg and take it away.
Thank you, Adele. Hopefully it is able to hear me and see the screen. It's a new topic, and it has a lot of ramifications for lots of people. And it's a first impression, so I'm going to make a presentation today with covering lots of territory, but welcoming your questions and comments. And of course, this is complicated, and you may well want to have a copy of the outline. You can certainly request it from us. You'll see contact information at the very end. And also asking questions, and feel free to. Your questions will be asked anonymously, and I'd be happy to answer them. But you can see the title. The 2023 Legacy IRA Act, which is an act within an act, is part of Secure, the new Secure Act, effective 1/1/23, January 1st, Secure 2.0 in fact. And so the topic is using tax-free IRA distributions for lifetime income, which we never could have done until now. So let me go down with you and look at just some simple definitions, because a gift annuity becomes the dominant vehicle in executing this plan that's been set up and allowed for us by Congress. And many of you already know, a gift annuity is a contract between you and a charity that is authorized by a state law, in this case, New York. In order to issue gift annuities, it's governed by the rules to protect annuitants, much like as if it were an insurance company, usually giving cash or marketable securities. The rates out in the gift annuity tables are the rates governing the rate for anybody of a particular age, because their rates are based off the averages of people's health in that age. It can run for one life or 2 lives. It can't run for a term of years, must run for lives. When the gift annuity is over, the residuum, you see that word here, the residuum is what remains in the gift annuity because it's been in a reserve account paying you for your entire lifetime or lifetimes, goes to the charity. In this case, it would go to Friends of Yad Sarah, and it allows you to get income stated, fixed, allows some of that income to be tax-free, runs for life or lives, so it goes well beyond life expectancy tables if you outlive the tables. And it also depends upon your age to your nearest birthday. So that's just a general summary. Contribution.
Neal, we already have a question. A question from the floor. Can this be done each year or only 1 year?
Well, I'm going to get to the particulars of the IRA Act in a moment. This is just intended to show you how it works. Now, if you'll stay with me a bit, I'm going to get right to that very quickly. Let me show you what the law has been that's been changed. In 2015, they allowed for the first time by congressional act signed by the president, enacted, they allowed that you could contribute money from an IRA directly to charity year by year, not for a gift annuity now, year by year, in the total amount of $100,000 if you're 70 and a half or over, and all the dollars coming out of your up to this amount that you made outright gifts to charity, including your RMD dollars, would be exempt from tax. So it was a very substantial bit of legislation. It was intended to be for 1 year. And we wondered, well, would it be renewed? Would it be renewed? It continued to be renewed and eventually became permanent. So forgetting the point of gift annuities for a second, if you're simply making QCDs, Qualified Charitable Distributions, from your IRA year by year and you're over 70 and a half, any of those dollars coming out of your IRA up to that number, which you make as contributions to your favorite charities, will be exempt from tax. No tax deduction, no tax. But in prior law, if you had a QCD, what I just described as Qualified Charitable Distribution, you couldn't contribute it. You could not contribute it to your donor advised fund. You could not contribute it to a private or supporting organization, foundation. And this is important, you couldn't contribute it to generate income for yourself or others. You could not do that. So we had this piece of legislation missing. We wanted it to be that way from the very beginning. Congress didn't agree. So specifically, QCDs from 2015 to 2023 could not be used to fund a gift annuity or charitable remainder trust. So that's the point we were at until the new act was passed. So you can see the title of this screen, Secure Act 2.0, particular section 307. They called it the Legacy IRA Act. It's very interesting, the phraseology they use, the Legacy IRA Act. For years, as you can see, the charitable sector had been trying to encourage Congress to let QCDs be used for gift annuities, for life income plans. There was an initial proposal early on that it would allow people over the age of 59 and a half, which is the age after which you can take distributions, although most people would not, to be able to establish a gift annuity up to the amount of $400,000. And that meant, under the plan that was proposed, that you could take money out of an IRA up to $400,000, transfer it to a charity, and get a gift annuity for a tax-free distribution. Never passed. Never passed. Congress just would not accept the number or the age. So what they decided, and even the proposal was, okay, let us do a gift annuity of this amount at this age, and anything we get in the gift annuity, once we get payments, would be taxed as ordinary income. The plan never got out of congressional committees, even though the proposals kept on reducing to 400,000, to 300,000, 200,000, never got enacted. Then comes Secure Act 2.0, what we're going to talk about today. And enacted in law effective January 1, this past January 1, the Legacy IRA Act. Now, this is going to the question just asked. This allows an individual, at least 70 and a half, to distribute up to a lifetime amount of $50,000 from an IRA as a CD to establish one or more gift annuities or charitable remainder trusts in a single calendar year. Now, just hear what I said. You can use up to $50,000 an IRA or a charitable remainder trust, if that's mathematically a good idea, in one particular year. That is your lifetime allowance. You can't do it in 2023 and then do one in 2024 and one in 2025. You can't do 30,000 in 23 and carry over the 20,000 for 24. It has to be done in a single calendar year by an individual up to a maximum of $50,000. It can be one CGA, or it could be 5 times $10,000 for 5 different charities, only in one particular year. So to the question asked before, at this point, a single year, a single aggregate amount, no carryover, no rollover. It comes out tax-free from the IRA. Now, let's think about the history for a moment. In 2015, when the QCD rule came in effect for outright gifts to charity, it was only in effect for a year. And so we wondered, would it ever be enacted again? Would it be extended? Will it continue to be extended? Takes me to the question about, will there be a possibility that this rule will be passed again for 24 or 25 and 26? Will become a permanent opportunity? Perhaps. Right now, I'm reporting to you what the law is. It's an aggregate amount, which means the $50,000, it's a maximum you can use all in 1 year for an individual. And it will adjust annually. Now, this is an important factor. If you believe that the inflation factor that will be fixed for 2023 will be high enough that the $50,000 maximum would be, say, $51,000 in 2024, you can wait till 2024 to do this and use $51,000 if the inflation factor allows that. We're betting on inflation multiplying the $50,000 by a certain multiple. If that's the case, people may say, I'll wait till 2024 because the rule allows me to do this $50,000 in any one calendar year. So I won't do it in 23. I'll wait till 24 if 24 allows me to have a higher amount than 50,000. If it doesn't get increased in $50,000 over $50,000 in 24 and gets decreased because of multiples, you will have less of a maximum amount. So to be very clear, in 2023, this year, if you want to take advantage of the Legacy IRA Act as an individual, you can use $50,000 this year. That's the maximum amount. You can use it to create one or a number of gift annuities or charitable remainder trusts, but all in the same year. Now, here are the rules. And this would be rules you want to think about when you're thinking about your own scenario. The beneficiaries of the gift annuity or the charitable remainder trust may be the IRA owner or spouse. No child, no friend, no partner. It's got to be a spouse, a legal spouse. Should be you if you own the IRA. Could be for your single life or for your life and the life of a spouse. The gift annuity has to be immediate. In other words, it's got to begin immediately. It can't be a deferred gift annuity. You can't say, as you could with cash, I'll create a gift annuity now in 2023. I don't want payments to begin till 2027. It has to be immediate, not deferred. Since you're not paying tax on the money coming out of the IRA to acquire this gift annuity, that's the purpose of the Legacy IRA Act. The money comes out of the IRA tax-free, but no charitable deduction, and all the income payable to you from the gift annuity will be ordinary taxable income. I'll show you in a moment why that may not be a problem in terms of how you mathematically calculate the benefit of it, but it's all ordinary income, no charitable deduction. That rule governs all QCDs, whether it be an outright gift to charity, which is the 100,000 limitation, renews every year, or a Legacy IRA gift of $50,000 in 1 year. The rule about income tax charitable deductions applies to both. No deduction. You're not paying any tax. So they're not going to give you a deduction. Now, if you create a gift annuity or charitable remainder trust, you and a spouse, you can't later on assign your benefits to anyone else. You can't even assign your benefits to a charity. Unlike gift annuities normally, or even charitable remainder trust, you could assign it at some point to somebody else. In the case of a gift annuity, you can only assign it to the charity that's issuing the gift annuity. So most people simply have the gift annuity for their life or lives, cannot be assigned. The fixed rate in the gift annuity or the charitable remainder trust can't be less than 5%. That's always been the rule for charitable remainder trusts. Gift annuities could be below 5%, but the rule now applies because if you're younger, that can always apply depending upon IRS discount rates. But now when you do the calculation for either a gift annuity or a charitable remainder trust, using the Legacy IRA Act, having money coming out tax-free, when we do the calculations, the rate cannot be less than 5%. Interesting, and this is something that may be applicable, although most people wouldn't create charitable remainder trusts for $50,000. It's just too costly to administer to have one with that amount of money. But if you do have a charitable remainder trust QCD, it's possible that the end of the CRT, the money in it, the remainder can go to your donor advised fund or to a family supporting organization. But again, it's probably unlikely that people are going to have charitable remainder trusts at $50,000. So this kind of tells you what the specific rules are. Money comes out tax-free, no charitable deduction as a consequence. Income payable to you from the gift annuity is ordinary income every year. It's 1099-R income. You can assign it. It's yours for the rest of your lifetime. The rate can't be less than 5%. In most instances, if you're 71, 72 into your 80s, the rate's going to be well above 5%. And with a CRT, this is discussion pieces now, but we believe this to be the case. The CRT remainder could go to your donor advised fund or to a supporting organization. General rules about the legacy. Now, these are a continuation of those rules for those of you who are looking at this thing as being two-life scenario. If both spouses have IRAs, and if they're both over 70 and a half, each of you can use $50,000 from your respective IRA to establish a two-life joint and survivor gift annuity, or two-life joint and survivor CRT. In essence, then, it would have $100,000 in it, 50 from you, 50 from spouse, 50 from both of you, and it would be based upon your two lives. It will run for both your lives and for the life of the one of you who survives the other, and the rate would be calculated based upon your joint ages to your nearest birthdays.
Okay, we have a question just for a point of clarification from the floor. If an RMD can be used to establish a charitable gift annuity or a charitable remainder trust?
Well, important question. If you'll note in the bullet point I'm pointing to right now, the maximum of $50,000 for a QCD for one person or $100,000 for two people would be able to be used to eliminate taxes on RMDs. So for example, let's say the $50,000 number I've given you happens to be your RMD for 2022 or 2023. If you took that $50,000 out of the IRA as a QCD and sent it to the charity to buy a gift annuity, you are now in effect realizing your RMD at no tax cost. That was the case also before the Legacy IRA Act. If you took the money out and gave it directly to charity with that $100,000 annual limitation, that's always been available to you, but it has not changed. So the maximum QCDs can be used and can be used to count against both the limitation, annual limitation, and to eliminate or reduce taxes on RMDs. So think about it this way. If you're used to giving charity $50,000 a year, that's your annual giving to all your charities. And you could give up to $100,000 in a year, but you chose not to because mathematically you wanted to be certain you could cover your RMD somehow. In this case, you could still use $50,000 in QCDs to do your gift annuity, and another $50,000 to either realize personally or give it to charity generally. You have the ability still to use $100,000, only $50,000 of which can be used to do the gift annuity. So, therefore, you can use these distributions to reduce or eliminate taxes on RMDs. And by the way, for those of you who have received inherited IRAs, thus you're also required to take RMDs from them. These rules also apply to inherited IRAs, not just to IRAs that are yours alone. So let's summarize this page. If you're a married couple and you both have IRAs, you can each draw the amount out of your IRAs. It doesn't have to be 50, it could be anything, but you can draw out of both your IRAs and have a combined CGA gift annuity for 2 lives, which could be as much as $100,000 if you both use 50. If you create a gift annuity, and this is something I skipped for a moment, and I have to talk about this for a moment, I'm always asked the question, if I use $50,000 from my IRA to create a gift annuity under the Legacy IRA Act, can I also use $50,000 in cash or from my investment accounts to make the gift annuity larger? Or if I fund the Charitable Remainder Trust with the $50,000 from my IRA, can I add $100,000 or any other number to make it larger? The answer is you cannot add to or have added to funds that are not QCD withdrawals. The gift annuity or the CRT must only contain QCD money. And that's an important question. Some people say, I'd like to put $50,000 tax-free from my IRA, and because I'm doing tax and estate planning, add a substantial more to my Charitable Remainder Trust and Charitable Gift Annuity. That second addition, that other amount must be a distinct gift annuity or a distinct Charitable Remainder Trust. It can't be added to or be part of a CGA or CRT at the $50,000 maximum through a Legacy IRA.
So that means that people could do $50,000 from their QCD and another amount, from cash funds that can increase their gift to the organization and to take advantage of all the benefits that a gift annuity can provide. Is that correct?
I'm not sure I heard you, Adele, but let me repeat because I think what you're saying.
I'm just making sure that it's clear. It's $50,000 maximum from the QCD and any other amount from, let's say, a cash or other source that can somebody can use to create an additional gift annuity with the organization, and therefore take advantage of more tax benefits and tax-free income.
Well, what you're saying is correct. You got a $50,000 QCD gift annuity, which was funded with tax-free dollars. Got another $50,000 gift annuity funded with cash or stocks or things. Both of them are separate. One is funded with money never taxed, not taxed, and one will be funded with money that has been taxed and comes out taxable from the IRA. So they're two distinct CGAs. They can't be blended together to make one. Who can benefit from what we call a Legacy IRA? Number one, those of you who don't itemize. And many people don't itemize. The point right now is that standard deduction for many people is more than adequate, and they don't have enough itemized deductions to take them in lieu of the standard deduction. So a lot of people are non-itemizers. So the charitable deduction that you don't get with a Legacy IRA is irrelevant. You don't get it, you weren't going to take it anyway, you wouldn't be able to take it, you don't itemize. Number two, if you are taking the money out of your IRA as a Legacy IRA and it's coming out tax-free, it isn't part of your adjusted gross income. It isn't counted toward ultimately figuring out your taxable income. So therefore, it's effectively what we call an above-the-line deduction. It doesn't create any tax costs because it is not going to be part of your adjusted gross income. Again, there are people who say, look, I just want to spread out my income tax costs over my life expectancy. I'll take the $50,000 out even though I don't get deduction, but I won't be paying tax on it, only to the extent I get income every year from the charitable gift annuity. So I'm spreading it over life expectancy, and I want lifetime income. Number 4, and this is the question asked a moment ago, who will benefit? Individuals who want to reduce or eliminate income taxes on their RMDs. And I think number 5, which goes to the point about all of us in this call, all of us who I believe have a connection in some form or another to Yad Sarah, individuals who want to leave a legacy for charity after the lifetime. So you get income for life or lives, using money that's not being taxed come out of your IRA. You could do it once in 1 year, and you'll get income for life. And when it's over, end of your lifetime, whatever remains, the residuum is going to go to Yad Sarah.
All right, we have another question from the floor, Neal.
Yes.
What are the limitations on the income from a charitable remainder trust if the distribution is done to a charitable remainder trust?
Well, the charitable remainder trust is not based upon a rate table like a gift annuity. Charitable remainder trust is based upon a calculation that relates to the monthly IRS discount rate and the life expectancy or expectancies of the beneficiaries. So I can't answer the question directly except to say to you, it can't be any less than 5%. However, if you use a charitable remainder uni trust, which adjusts every year, the rate doesn't adjust, but the payments adjust every year based upon the value of the charitable remainder trust at the close of every year, you may be beating inflation a bit, but you're taking some market risk. So to answer that question, a rate will be fixed, 5% or greater, depends upon the age of the individual. And we can calculate that for you if you want to inquire at Friends of Yad Sarah. We can calculate all this for you just in confidence without any obligation. And you can compare that rate against the rate for a gift annuity to see what it would be. I've circled around that question because I can't answer it without having more details. It can never be less than 5%. It can be higher. And the highest rate for a charitable remainder trust is a charitable remainder unit trust, which adjusts every year in terms of payment to you based upon the end of the year revaluation of the trust. Just some calculations for you to look at. It's March. We have a new IRS discount rate for March. Here's an individual, 2 individuals, ages 79 and 77, a couple, and they decide they want to take advantage. So they're going to contribute, each of them $50,000 from their IRA to create a $100,000 gift annuity. The rate for these 2 individuals, based on the tables that are presently in use, is 6.6%. It will run for their joint lifetimes. It will be payable to them quarterly. They will get an annuity of $6,600 a year. They get no charitable deduction. Why no charitable deduction? Because the rule says if you don't pay tax on the money coming out of your IRA, you don't get a deduction behind it, but you get this income assured for both of you for your joint lifetimes. Now, suppose it's an individual, age 72. And this individual, male or female, decides that a gift annuity would be good to you for one $50,000 withdrawal from an IRA in 2023. The rate for that person, based upon the tables, will be 6.7%. And 6.7% times $50,000 means the receipt of payments for life will be $3,350 a year, payable quarterly, rate of 6.7, no charitable deduction because no tax cost in bringing this money to the charitable gift annuity.
And payments can also be made monthly or annually. It doesn't have to be quarterly. Is that correct?
That's correct. You can get it monthly, quarterly, semi-annually, or annually. You can choose what it is. The change in the calculation in the case of a legacy IRA won't affect whether you get paid monthly or quarterly. You'll still get the same amount of annuity, just spread out in different, more frequent payments. Now, let's take a gift annuity now, not a legacy IRA gift annuity, but a gift annuity taking money out. Taking money out of your IRA and pay tax on it. Then create a gift annuity. Same donor, a 72-year-old donor has a 14.5% life expectancy under the tables. That donor takes $50,000 out of an IRA, not a legacy IRA, a regular IRA, pays tax on the $50,000, and then gets this annuity at 6.7%. Same payment as before, but now there's a charitable deduction. $19,494, that's the charitable deduction for using cash, essentially what you've done to create a gift annuity. If you're paying federal and state taxes in the states that you're in that may have state taxes, and your combined marginal rate is 25%, that tax deduction, if you itemize, will save you $4,874 in tax, which will thus reduce its cost. So if this annuity, gift annuity, is actually costing you after your tax savings $45,126, and you're getting paid $3,350, your effective return is 7.4%, and your tax-free portion, based upon life expectancy and the IRS discount rate, means that every year for the first 14.5 years of the $3,350, 62.8% of it is tax-free. This is the traditional, pure charitable gift annuity using cash from an IRA, from your bank account, or your money market fund, whatever it might be. Let's look at the same scenario with the 2-life example we did before. Individuals 79 and 77, their joint life expectancy is almost the same as the life expectancy of one 72-year-old. The joint life expectancy is 14.2 years, even though they're older. Joint individuals are presumed actuarially to live longer than anyone individually. They get 6.6%. They receive the same $6,600, but now they get a charitable deduction. Nearly 38.5% of the contribution, which is taxable money, is deductible. If their marginal rate is 25%, they will save over $9,600 in income taxes if they itemize. That means the net cost of this annuity is a bit over $90,000. Higher effective annuity rate, and again, for the first 14.2 years of the $6,600, 65.7% is going to be paid to you tax-free. So the question has been arising, and people have been asking me for some analysis. Would I be better off doing a gift annuity and paying the cost of the money coming out of my IRA, or using cash, or paying and getting my charitable deduction? I'm an itemizer, they say, and getting some tax-free income, same rate, same payments, except we're going to pay some tax on it. Or am I better off not doing that and using the Legacy IRA? So I'm doing two side-by-sides here. Take a look at this for the couple, 79 and 77. Remember, they used the money as a Legacy IRA move, no tax. They got the rate of 6.6%. It'll run for the lifetimes of 14.2%, 14.2 years, and they'll get a payment of $6,600, but no tax deduction. Same scenario, same amount of money, taxable money, same rate, same annuity. Now we get a tax deduction. We're going to save some money on taxes as a result of this deduction if we itemize. Our net cost, therefore, is going to be lower. Our effective rate is higher, but we're paying tax on some of this money, and our tax-free portion means that about 34.3% of it is taxable, as opposed to 100% of it is taxable over a period of 14.2 years life expectancy. When you look at these two side by side, it really deals with what your personal circumstances are. Are you an itemizer? If not, this can't be the better call. Number two, are you going to be doing this with money you were going to expect to pay tax on, or you already pay tax like money's in a savings account? Maybe a different scenario. You might choose to do that, but I'm trying to compare the Legacy IRA with taxable IRA cash. So when looking at this, are you an itemizer? Do you want above the line deduction, or do you want an itemized deduction for charitable giving? Do you want some of the income payable each of you during the year to be tax-free? You've paid tax on the money already, so you're going to get some of it back as return of principal. This is an interesting scenario for those of you looking at both ideas to see which one works better. I think the Legacy IRA in most instances is going to be the better call, because it could be RMD money. It could be money you have to take out anyway. So you have to take it out anyway, and you don't want to pay tax on it. Then logically, you would want to consider something that provides income for you for life. So create a gift annuity. For the single life person, very quickly, same age, life expectancy of 14.5 years. Remember the rate 6.7, same thing applies. Same annuity on both scenarios, except if you use taxable IRA cash as opposed to Legacy IRA tax-free money, You get a tax deduction if you itemize, some tax savings, and some tax-free portion. Interesting dynamic here to relate one to the other. If you're not an itemizer, much easier call. If you like to have the money payable to you over life expectancy and pay tax that way, but not pay tax at all in the beginning, this is an easier call. To be compared, to be looked at. So in closing, subject to any more questions you may have, I just posted here the offensive Yad Sarah gift annuity rates for March of 2023 in 5-year multiples for the age of an individual single life age 70 through 90 plus. Shows the rate and shows what portion of the annual annuity amount will be tax-free, assuming you use taxable money. And the way we know this tax-free amount is we look at the month you create the gift annuity, look at the IRS discount factor, and we then come with a calculation. A lot of information I recognize and a lot of things that you may be hearing for the first time. And a lot of this is something you need to ponder. We're happy to calculate for you. We're happy to discuss this with you privately. We're happy to receive information from you. And of course, we'll be pleased to send you the outline and the recording if you want, so you can listen to it again. It's a very interesting new piece of legislation, particularly for people who are philanthropic, particularly for people who are over the age of 70 and a half, who are looking to build up their retirement income, and particularly for people who are taking RMDs and are trying to find a way to take an RMD out that comes out tax-free. So I leave you with this and turn it over to Adele and invite you to inquire some more and see if we can't be a help to you in making the decision. Thanks. To you, Adele.
Thank you very much, Neal. That was incredibly informative and a lot of information to digest. So I know that I will probably have to review this information just so that I can be an informed advisor or guide for anybody who calls and asks questions. But as Neal said, you can feel free to reach out to him directly in confidence, and there's no obligation to proceed. We're happy to do the calculations for you to see if you can, so that you can see if this is a good fit for you. These are very important gifts for Friends of Yad Sarah. So we certainly hope that you will decide to move ahead and trust us with this important gift. And we're appreciative of any consideration that you can give us. As I said, feel free to be in touch with us with any questions you might have. You can reach out to me or to Neal directly in confidence. You may tell me that he spoke with you, but he won't tell me what you discussed. So I want to thank you all for your participation and for your attention and for your support of the organization and for your generous partnership, which enables so much good work for so many people in the land of Israel. Thank you very, very much, and best wishes for a happy Purim.
Goodbye, everybody.
Oh, we have another question.
Oh, you do? Okay.
Somebody says they'd like a video copy of this Zoom. Yes, everyone will get a video copy of this Zoom as soon as we're able to upload it onto our YouTube channel, but you will get it via email.